What the trade imbalance reflects is an enormous amount of capital pouring into the United States, which leads to the financialization you were talking about. We're receiving so many capital inflows, we do have a trade deficit. So the strong dollar, as a result of those capital inflows, means that we're crowding out manufactured exports and we're crowding in and making cheaper foreign manufactured products. This is a really wild time. If you think this is normal, it's not the way things have been for the past few decades. It's historic what's going on in terms of the reshaping of the world economy as a result of these tariffs.
Today's episode of Monetary Matters is brought to you by VanEck's semiconductor ETFs. Later on, you'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and their newer VanEck Fabless Semiconductor ETF, ticker SMHX. Let's get into it. Today, we've got an incredibly important conversation. The Trump tariffs, long awaited, are finally in effect. And today I am joined by Professor Douglas Irwin, Professor of Economics at Dartmouth. Doug is the leading economist when it comes to trade and trade history in the United States, and we're incredibly joyed to be joined by him today. Professor, welcome to Monetary Matters.
It's nice to be here. Thanks for having me.
I want to start off just with the scale of these tariffs. Roughly, when it comes to the Trump tariffs, how big are they in a rate of change basis compared to, let's say, the Smoot-Hawley tariffs of 1930 during the Great Depression?
Well, these tariffs are off the chart in terms of the change. So we've gone from an average tariff of about 2 or 3% up to about 18%. And that's pretty much almost overnight. Obviously, it's taken place over a few months now, a few weeks and months. This is a really wild time. If you think this is normal, it's not the way things have been for the past few decades. Trade is usually sort of a backwater. Things are very quiet and just operate in the background. And it's historic what's going on in terms of the reshaping of the world economy as a result of these tariffs. When we look at changes in the past, there have been fluctuations in the tariff, but usually when Congress was in charge of the tariff, which is from Smoot-Hawley back to the beginning of the country, all the tariff changes were pretty incremental. There's a big tariff change at the beginning of the Civil War because we needed the revenue to fight that war. There were some big changes, around World War I. But generally, we don't see huge discontinuities like this. All previous tariff acts have tended to be incrementally push the tariffs up or down from the previous level. And this is going from very low levels to really pre-1930s levels almost overnight.
And that Smoot-Hawley tariff, it took them from 39% to 45%, or a change, but not that big change, right?
Exactly. Yeah. So two things to point out here. So it went from about 38% up to about 42, something like that. There's no hard and fast calculation, although I've tried to come up with some numbers. But what really pushed the tariff up after 1930, higher in 31, higher in 32, up to almost 60%, was the fact that a lot of the tariffs at the time, there's sort of an anomaly in the tariff code. A lot of the tariffs at the time were nominal duties. They're what's known as specific duties, a specific dollar amount per imported quantity. And what that means is that the ad valorem equivalent of those duties is inversely related to the prices. So let me just give you an example. If we have a tariff of $1 per shirt, so that's not a percent, it's just $1 per shirt. If you import a $1 shirt, that's a 100% tariff. If the price of that shirt falls 50 cents, that's a much higher tariff in terms of the value of the goods. And that's what was going on during the Great Depression. We had price deflation. The price level fell by about a third between 1929 and 1933. And so what that did is it pushed up the effective tariff a lot more. So in the past, unlike today, there are two things that were sort of driving those tariffs: legislative change in the rates, and then the impact of prices. Prices don't have those impacts on tariffs anymore because we generally use ad valorem tariffs, but we're seeing big changes in policy that's made a major difference here.
The Smoot-Hawley tariff of 1930, the timing is odd. The Great Depression was from 1930 to 35 or 36. So a lot of people attribute the Great Depression to the Smoot-Hawley tariffs. Did these high tariff rates going from 38% to 42%, did they cause the Great Depression? How do you establish a causal link?
I'd say most economic historians don't think it caused the Great Depression, but it probably exacerbated it. And then there can be a debate about how much it exacerbated it. Here's why it didn't cause it. First of all, the tariff was not enacted until June of 1930. We hit a business cycle peak in August or September of 1929. So after that time, industrial production was falling, unemployment was increasing. Obviously, the stock market crashed in the fall of 1929. But here's another point. the Great Depression was a worldwide phenomenon. It wasn't just the US. And every country, well, with a few exceptions, almost every country in the world sank into the Great Depression, even if they kept their tariffs the same or even if they reduced them. So the tariff wasn't the causal driving factor. There's a great book you're probably aware of by Milton Friedman and Anna Schwartz called A Monetary History of the United States that sort of talks about the importance of monetary causes. And then other scholars like Barry Eichengreen and Peter Temin have pointed out, well, it wasn't just a US monetary phenomenon, it was a global monetary phenomenon. The gold standard played an important role in transmitting the Great Depression across countries. And the gold standard malfunctioned because of what central banks were doing. That's a whole other article, topic we can get into. But so it wasn't just the tariffs that was going on. And a lot of countries that didn't fiddle around with their trade policy also had a Great Depression as well.
And Professor, a lot of people are probably aware that the Great Depression was caused by monetary instability and deflation, and central banks, in order to stay on the gold standard and to prevent an outflow of gold, they had to tighten monetary policy in order to stop gold outflows as the business cycle was slowing down. They all did that at the same time. And people may be aware of the Smoot-Hawley at the back of their mind. I was aware of the monetary thing. I knew the trade was going on, but it wasn't until your book, Trade Policy Disaster, that I learned of the connection between these two. So in macroeconomic policies, people may be aware of something called the monetary trilemma or impossible trinity, where basically countries can have two of the following three things: free flow of capital, a fixed exchange rate, or sovereign monetary policy. They can have two of those things, but they can't have all three. You write about a slightly different trilemma, an older trilemma, the interwar trilemma of countries can have a gold standard, free trade, or independent monetary policy. Explain the nature of this interwar trilemma. Why did countries have to either go off the gold standard or raise tariffs?
Sure. Well, that's not original to me. It actually comes from Milton Friedman as well. But what Milton Friedman noted this is actually in an early draft of his essay on the case for flexible exchange rates. He said Keynes, John Maynard Keynes, in his book Tract on Monetary Reform, pointed out the dilemma where you could have a stable exchange rate, a fixed exchange rate, or a stable monetary policy, a monetary policy that stabilized domestic inflation, but you couldn't necessarily have both. There might be a tension between the two. And you might have to choose between keeping the exchange rate fixed and having monetary stability if there's uncertainty and instability in the international system. And what Friedman pointed out is that actually that dilemma had become a trilemma during the 1930s. And so the way to think about it is this way. Let's say there's worldwide deflation and you don't like that. There's one of two things you could do. You could let your exchange rate go and use monetary policy to target the domestic price level, not worrying about the exchange rate. Or you could keep that exchange rate fixed, but then you'd have to sort of ride this, you'd give up domestic monetary autonomy because you'd have to import deflationary policies from abroad. The way to get around that and keeping the exchange rate fixed while keeping your monetary autonomy was to impose exchange controls. Controls on foreign capital flows, controls on imports and exports. And that's what a bunch of countries did during the Great Depression of the 1930s, particularly Germany and others. They didn't want to devalue their currency. They didn't want to have big deflation. And the way to sort of bridge that gap was to impose either high tariffs, quotas, exchange controls to limit your ability to preserve your ability to maintain the fixed exchange rate while not having domestic deflation.
And of course, everyone had fixed exchange rates at the time. Most countries, because they were fixed to gold, and if I'm fixed to gold, you're fixed to gold, we're fixed to each other.
Exactly.
So a lot of European countries had exchange control. So you really had three countries. You could stay on the gold standard,
Yep.
you could devalue your currency,
Yep.
or you could officially not devalue your currency, but you could suspend convertibility. And the way that you would do that is through exchange controls. Where do tariffs come into play in all this? And talk about the three countries: the gold block, the exchange control block, and the tariff block.
Yeah, it's easiest with the exchange control block. So what happens is let's say you're experiencing a capital outflow. That makes it very difficult to maintain your exchange rate. So if you want to keep that exchange rate fixed, however, when gold is flowing out of your country, you have to stop that in some way. One way would be by raising interest rates, but then you put the economy through a ringer that's tightening your monetary policy. So let's say you don't want to do that. The way to do it would be to impose tariffs, because what tariffs do is they don't limit the outflow of gold so much, but they limit your foreign expenditures. And therefore, implicitly, it would keep the gold outflow less than it otherwise would be because you're spending less on foreign goods. And so it's an indirect use to achieve a monetary policy objective using those tariffs to limit capital outflows. And so that was the rationale for using protectionist policies in some countries during the Great Depression. So other countries like France and Belgium, they stayed on the gold standard for a very long time, endured a lot of deflation. They didn't so much go for protectionist policies, but other countries did so that want to maintain their exchange rate and yet maintain their monetary autonomy at the same time.
Like the United States.
Exactly. Yep.
And how did that play out for the United States? And basically, instead of devaluing your currency, you put a tariff in, which I'm learning they have a similar effect. I know there's lots of differences, but if the dollar were to weaken by 10%, it's similar to a similar stimulative effect to exports and domestic production, and a crimping of imports as a 10% tariff somewhat. So talk about how the U.S. fared with that tariff in place.
It didn't stop the U.S. from falling into the Great Depression. The monetary forces are so overwhelming. Using a tariff to try to keep more gold for yourself and have a more expansionary policy is just very, very difficult thing to do. We saw that the U.S. didn't really recover or start to recover from the Great Depression until we devalued the dollar in the spring of 1933 under President Roosevelt, in which case the tariffs were much less necessary. And in fact, other countries followed that too. When they left the gold standard, they could reduce their tariffs because they weren't needed for that monetary purpose anymore of limiting outflows of gold or other forms of capital. So the U.S. experience, it's using trade policy to achieve monetary policy objectives. It's very indirect, very weak, not the right approach to take.
And how much do you think that the tariffs exacerbated the Great Depression?
Yeah, that's a great question. I mean, and there's a difficulty in marrying microeconomic analysis and macroeconomic analysis. So in terms of the microeconomics, any tax imposes a deadweight loss, and there are going to be losses, static losses from trade as a result of higher tariffs. And so these are sometimes called Harburger triangles, areas under demand curves, and you can calculate those things, and they tend to be very small. So the microeconomic losses tend to be small and not really able to account for the Great Depression itself. But there could be macroeconomic influences that would have a more direct impact on GDP, fall in exports and imports and what have you. And even when you take more of a Keynesian or monetarist approach and try to look at sort of the total GDP effects of those tariffs, they turn out to be relatively small. And the reason is pretty simple. The US, unlike today, the US in the late 1920s, early 1930s really wasn't engaged in world trade to any great extent. Trade, exports and imports are about 10 to 15% of US GDP today. Back in 1929, it was about 5%. So you're just talking about a smaller part of the economy that's being affected by those tariffs. And yet you're seeing investment collapse, you're seeing consumption collapse, and it's very hard to use the tariffs on a small share of GDP as having this overwhelming influence on the national economy.
So if the tariffs that President Trump is enacting right now are bigger as a rate of change than the Smoot-Hawley tariffs, and the U.S. economy is more exposed to trade than it was in the 1920s and 30s, do you think that it will have a worse effect than the Smoot-Hawley tariff had? Admittedly, the Smoot-Hawley tariff did not cause the Great Depression, but you say it exacerbated it. Do you think it's going to have a worse effect, a bigger effect?
It could very well have that impact. I mean, one of the things in the 1930s, there was a lot of things going on. A lot of countries retaliated against the U.S. A lot of other countries imposed trade barriers too. So the whole system was sort of imploding in some way. We're not seeing that so much today. There's not so much retaliation except by China and maybe now India against the U.S. We're not seeing other countries mimic the U.S. and throwing up their trade barriers as well. So the international environment is a little bit different. But for the reasons you point out, the rate of change in the tariff and the exposure of the U.S. economy to trade is much greater today. And so when you look at most estimates from probably the CBO will have its estimates, the Yale Budget Lab has its estimates, the Peterson Institute for International Economics have done all these simulations regarding the impact of tariffs. We're talking about shaving between, say, 0.3 and 0.5% of GDP. We don't know exactly what time period that will play out. It could be over 6 months or a year. And if you want to convert that into growth rates or something, it's shaving a little bit off the growth rate in the United States. Not by itself necessarily enough to push the U.S. into a recession necessarily, but if you have an economy that's growing at like 1.5 to 2% a year, And for over the next year, say you lose half a percentage point of GDP, that should be measurable in terms of the data coming out in the third and fourth quarter of this year.
So 30 basis points, 50 basis points decline in GDP growth, that is a far cry from the huge declines in GDP and trade during the Great Depression. Why are tariffs so almost uniformly loathed by economists?
Well, I think because they're a poor policy instrument for achieving just about any objective that you want. So I have another book called Clashing Over Commerce, which is a history of U.S. trade policy, which I see you trying to bring up right now. So there I talk about the three R's: revenue, restriction, and reciprocity. So think about revenue effects. Tariffs raise revenue. They've been used for a long time in the U.S. Over U.S. history to raise revenue. But the question that an economist would pose is, are they the most efficient way of raising revenue? That is, the principles of tax policy are you want low rates and a wide base because you don't want to distort much economic activity. Well, the problem with imports is, and now what we see is we have high rates on a small base, the small base being imports. So yeah, we're going to gain some revenue, but it's just an inefficient form of raising revenue compared to other sources. And of course, given the size of the fiscal deficit, given the size of federal spending, there's no way we can finance the federal government today with tariffs the way we could in, say, 1820, when government spending was much smaller as a share of GDP, only about 3% or so. Restricting imports. Well, that's an objective too, and tariffs can achieve that objective of restricting imports. But then the question is, well, why do you want to do that? And all sorts of reasons why that may not be a good idea. You're giving up some of the gains from trade, but it's going to hurt consumers and other producer groups that benefit from trade. You might help out some industries, such as the steel industry, if we keep out foreign steel, that has downstream ramifications for steel using industries, and will hurt jobs and employment and output in auto industry, machine tool industry, all those others that use steel as an input. So they're a lot more sharp trade-offs with respect to using that to sort of reindustrialize America. And of course, a lot of international trade is in intermediate goods. Semiconductors are not a final good; they're used as an input to production. Steel is an input to production. Sugar is an input to production. And whenever you raise the prices of those intermediate goods, you hurt those downstream producers by raising their costs. And so the objective of reindustrialization through tariffs is much more complicated in a world where much of the trade is in intermediate goods as opposed to final goods.
And so, sorry, those three R's are
revenue, restriction, and reciprocity. And so the question you would ask was, why do economists not like tariffs? Well, there's gains from trade, so you're reducing some of those gains from trade, but also all these other objectives, they're much better achieved by using other policy instruments, whether it's revenue, whether it's trying to help out a domestic industry. Who doesn't want to help out domestic industries? But subsidies or tax credits might be a more efficient way than imposing tariffs, which is going to raise the price to consumers and force all sorts of adjustments on other industries. Then there's a question of reciprocity, and that's where U.S. trade policy has been for the past 70 or 80 years since World War II, is we've agreed to reduce our tariffs if other countries reduce theirs. In either free trade agreements such as NAFTA or free trade agreements we've had with Korea or Australia or Chile or Peru, or through multilateral means such as the GATT and the WTO. And that's reduced the tariff that U.S. exporters face in foreign markets quite considerably. And that's, of course, what's being upended today with the Trump approach to trade.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack from design to manufacturing. Historically, this unique construction and methodology has helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHJack to learn more. Using a similar philosophy, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXJack to learn more. And now, back to the interview. And what about tariffs trying to promote domestic industry? I know there's a long history there. How successful are they in doing that?
Well, the problem is, as I mentioned, you may help one industry, but you're going to hurt a lot of other industries. So let's say any firm that's facing import competition, we want to help them out. You know, a depreciation of the dollar probably would help them out more and would stimulate exports. But the problem with tariffs is they're going to indirectly reduce exports. So you may gain some jobs in import competing industries, but you're going to lose jobs in export oriented industries. So by raising tariffs on aluminum and steel, for example, that doesn't help Boeing, and Boeing's a big exporter. That doesn't help General Electric, and General Electric's a big exporter. It doesn't help out John Deere, and John Deere's a big exporter. So if you limit imports, you implicitly limit exports at the same time, and that overall doesn't help the economy.
By limiting imports, you limit exports because of this intermediate effect. If okay, it helped putting steel tariffs in helps steel producers, but it does not help car manufacturers. Is that 100% of the fact you're referring to, or is there also an element of exports go down because there's trade retaliation?
Yes, so I'd say there are three factors one can point to for why an import tariff would lead to a reduction in exports as well. One would be you're raising costs. That's one we just talked about. The second one is the one you just mentioned, retaliation. That hasn't happened so much now, but of course, China, India, and other countries probably have or will retaliate. The third one would be exchange rate effects. So, all other things being equal, if we impose higher import tariffs, that should lead to an appreciation of the dollar. Why? Well, because when we're importing, we're putting our dollars from our pocketbooks out onto the foreign exchange market. And if we stop doing that because those foreign goods become more expensive, we stop putting our dollars on the foreign exchange market, the dollar is going to rise in value. And that will crowd out US exports. That's the theory. And it has played out that way in the past. However, what's interesting about the Trump tariffs of 2025, particularly after Liberation Day, is that when those were announced in April, the dollar began falling in value, not rising, which is sort of the opposite of what one might think. And you might recall it wasn't just the stock market that was declining quite a lot in April, but also the US bond market was tightening up, yields were going up, prices were falling. And the dollar, surprisingly to all observers, started falling in value rather than rising with US interest rates. So there was a decoupling, a delinking of bond yields and the value of the dollar on foreign exchange markets. And so this raised the question of, is the US is losing its exorbitant privilege? Is the US sort of pulling back from the world market in some way that foreign investors now no longer want to buy US dollar denominated assets as much as they did in the past? And so that was a different odd reaction.
So tariffs are similar to a weakening of the dollar, but they also are theoretically supposed to strengthen the dollar, so it could have that offsetting force.
Right. So there's something in trade theory called the Lerner symmetry theorem, named after Ava Lerner. It basically says an import tariff is equivalent to an export tax. And there's various mechanisms by which that holds. Dollar appreciation would be one of them. As I mentioned, haven't seen that in recent months, but it still doesn't mean that that proposition doesn't hold, because when you look at any country, including the United States, over the long run, basically the level of its exports matches the level of its imports. And that's for most countries, except the US, which has this exorbitant privilege with the dollar. If they want to import from the rest of the world, they have to export. That's their way of paying for those imports. The US is a little bit in a different situation because we produce the reserve currency of the world. We can just print dollars and import. But for most countries, exports and imports are pretty closely linked.
And I think a lot of supporters, or at least partial supporters of the tariff measures, they see an imbalance. They see the US trade deficit getting bigger and bigger every year in absolute terms. As a percentage of GDP, I think it probably peaked around like 2000 or 25 years ago. But you year after year, the trade deficit is persistent, and they see
Yep.
jobs going overseas. They see, things used to be made in the US. Now everything is made in, Cambodia or Vietnam or China or other places. And basically, the good jobs in America, are now working on Wall Street or in technology. And you can't, there aren't nearly as many good paying jobs that are in a factory that maybe required less training. So I think people are I think that phenomenon is a key reason why President Trump got elected in 2016 and then in 2024. To what degree is there an intellectual basis for the or a germ of truth at the core of that argument that the U.S. basically is being treated unfairly on trade, regardless of whether the Cambodia and other countries actually treat them unfairly, or if they actually have high tariffs. But the existence of the persistent trade deficit itself shows that something should be going on, because doesn't trade theory hold that if a country has a trade deficit, its currency should weaken and therefore make it more competitive, and then they restore a balance? Why hasn't that happened for 30 to 40 years?
There's a lot in there, so let's try to break it down just a little bit. I'll try to just make 2 points. One is the loss of manufacturing jobs in the U.S., and whether that's due to foreign competition or other factors. And here, going back to the steel industry, this is a very important case. Overwhelmingly, and I think some people have done the calculation, it's about 90%, a little less than 90%, of the job loss in manufacturing is due to improvements in productivity and technological change and the substitution of capital and technology for labor rather than imports. How do we know this? Well, the steel industry. In the 1980s, it took 10 worker hours to produce a ton of steel. There's HBO now has a program on Billy Joel, a documentary on his life. And he has this famous song called Allentown. And you hear the pounding of steel. And it's all about exactly what we're talking about, the loss of jobs in the steel industry. In the 1980s, as I mentioned, it took 10 worker hours to produce a ton of steel. Today, it takes 1 worker hour to produce a ton of steel. Now, we're producing just as much steel as we did back in the 80s. It's been pretty flat in the US, but we need 1/10 the number of workers to do so because of productivity improvements, because we don't have manual physical labor, blue collar workers in there pounding out, iron rod or what have you. It's all mechanized. It's all machinery. And that one worker that's producing that ton of steel, it's a very different type of worker than it was in the 1980s. It wasn't a blue collar worker. It's probably a graduate of Carnegie Mellon or Lehigh. And they have a degree in chemical engineering or or other types of engineering, maybe even computer engineering, and they're monitoring the dials on all the machinery that's pumping out the steel, because there's software behind that. It's not just physical labor anymore. So in other words, we're still producing cars, we're still producing trucks, we're still producing steel, but it's all become capital intensive. It's robots or other things in the auto plants, and what have you. So there's been a big change in the nature of production away from labor towards capital. So foreign competition is part of the story for certain industries in particular, textiles and apparel and furniture. We have lost those industries, and they were lost mainly due to foreign competition and the jobs with it. But the jobs in other parts of manufacturing, that's more of a technological story than a foreign competition story. Now, about the trade deficit, that's a very important point too. And you're right, for most countries that are not that don't borrow in their own currency or what have you, trade tends to be much more balanced. Current account imbalances tend to be limited. But since the early 1980s too, here's where there was a big change in the world economy. The world has been open to trade in assets. Capital flows are enormous. And what the trade imbalance reflects is an enormous amount of capital pouring into the United States, which leads to the financialization you were talking about, and the fact that we are a big exporter of financial services and an exporter of assets in some sense. That's being driven in large part because foreign investors are seeking high rates of return or safe assets. The high rates of return come from the US stock market, which has outperformed most foreign stock markets for decade upon decade. We have the venture capital, we have the tech startups, the value of our companies, which are run so well, has really supported that much more than other countries. So people want those high rates of return, but they also want safe assets. That is, if they have some savings, there's no safer place to put it than a treasury bill, because it's a low rate of return, but it's a guaranteed rate of return. There's very little political risk until recently, very little economic uncertainty associated with that. So the U.S. is not the victim of foreign unfair trade practices as so much. It is the success story where other countries want to invest in the U.S. Now, here's where the grain of truth into what you were saying is absolutely right. By receiving so many capital inflows, we do have a trade deficit. And what that means is we're importing more than we otherwise would, and we're exporting less than we otherwise would. And a lot of trade is in manufactured goods. So the strong dollar, as a result of those capital inflows, or the stronger than otherwise would be the case dollar, means that we're crowding out manufactured exports and we're crowding in and making cheaper foreign manufactured products. So that's where there is that truth to that statement. Now, some economists, Robert Lawrence at the Peterson Institute and the Harvard Kennedy School, have done calculations suggesting that if we balanced our trade account, had a balanced current account or what have you, we would have 1 million more manufacturing jobs in manufacturing than we have today. So that's not nothing. That's something. But in a labor market where we have, almost 200 million people employed, that, those workers would have to come from somewhere. Less in services, maybe less in financial services, more in manufacturing. Maybe that's a desirable thing to do. But then we can get to, what the remedies might be. And the remedies would be, in my view, if we want to reduce the current account deficit, would be to reduce the U.S. fiscal imbalance. Because one reason why there's so much capital coming in is because the federal government issues so much debt and at attractive rates. So there's a link between fiscal policy and the way the current account moves. We could also consider, taxing foreign capital inflows. That would have all sorts of problems as well, but it would be a much more direct way of addressing that particular concern than imposing tariffs.
Earlier, you said that we used to have to produce one thing of steel. You had 10 employee work hours, man hours. Now you have one. I totally grant you that. But what about China? Like I looked up I think the 9 out of 10 or maybe 10 out of 10 of the top biggest producing steel companies are in China. The
Mhm.
other one is European. U.S. Steel, the ticker is X, and I think that's the descendant of created by Carnegie, Andrew Carnegie. So you mentioned that the employee would be had gone to Carnegie
Right.
Mellon, but that's I looked up, it's the 29th biggest steel company in the world. Why aren't we why get we have 5 or 6 or 7 of the top U.S. steel producers in the world? I totally grant you the point that it's way more efficient, that the average unit of steel now requires far fewer workers. But I mean, there are a lot of people in China, I imagine, who are work in steel mills. Why is that so imbalanced? Is it because China was a poor and is still a poorer country, so that wages are lower, and that it's is it that the government's subsidizing steel? Like, why can't we build steel in this country?
I would suggest we actually still do build steel, and we do import some steel as well. We're a net importer. Those imports don't come from China because we've already hit those. Even before the Trump administration, we had a lot of tariffs on Chinese steel through the anti-dumping laws and countervailing duty, all sorts of other administrative acts that have been invoked for decades to keep out Chinese steel. But here's the more specific issue that's the problem with China and more generally, but also in steel in particular, is China's not a market economy. They have private producers, but they're not really a market economy. They have enormous excess capacity in steel in China. Now, of course, the demand for steel is much larger than is the U.S. because they've been building a lot and what have you. But they're indirectly supported by the state, by public banks, which will make loans to them at terms we don't really know, but we consider don't really require repayment or can be easily written off, very low interest rates. So that the Chinese government implicitly has subsidized many of its manufacturing industries through cheap credit, not through direct subsidies, what have you, but hidden through the credit system, the bank lending system. And by creating a lot of excess capacity, they've really deterred some production in Europe and in the United States. So electric vehicles would be a great case. I think I've heard it said that there are over 100, probably close to 200 firms that are startups trying to produce EVs in China. We have maybe half a dozen or so, and the government is encouraging this and basically giving you free credit to start up these things. Now, most of them are going to fail, but some, such as BVD, are at the cutting edge and have done incredibly well. So they subsidize 200 firms, and maybe 2 or 3 will produce really high quality products and survive. But that's been their approach. Now, that does have a downside for the US. By glutting the market, it's deterring entry by US producers. And that's a problem that should be addressed. But then the question becomes, how do you address that? Are tariffs the right way? Do you have to negotiate with them or what have you?
So if China is basically using non-market forces to subsidize investment, it's giving ultra cheap loans that may or may not have to be paid back, giving free land to all of these startups to promote production, then I think I see 3 doors. Number one, we do non-market forces and we do tons of subsidies to domestic production. Door number 2 is we do tariffs, or door number 3 is, to use the president's language, we continue to get killed on trade, meaning that the U.S. manufacturing as a percentage of global GDP continues to go down, down, down. Do you see a door number 4, or are those 3 doors the only 3 possibilities? And if so, which door do you want to go into?
I think ideally what I'd like to do is see China move to become a more market-oriented economy as they had been initially under Deng Xiaoping, and they've gone in a very different direction under President Xi. I wouldn't put much stake in that outcome, however. So I do think that second order of tariffs just levied on China is sort of the way we have been going and the way we'll continue to go. So what's going on there? It was the Biden administration that put on 100% tariffs on EVs. But notice this is very different than what President Trump is doing. It's not saying we're going to tariff or put tariffs on everyone, on all imports, because there are a lot of market economies. There are friends that are out there. It's saying we have to treat China differently and distinctly through tariffs or what have you. Now, that still is an indirect way of dealing with things because it doesn't really stop China from developing excess capacity. That capacity just may spill over to other markets, such as Europe and what have you, and they may be forced to raise their tariffs as well. So I don't deny at all that China's a problem, and I think tariffs are one way of dealing with them.
Earlier, when you acknowledged the seed of truth in the pro-tariff argument about the overvaluation of the dollar, the rest of the world buys U.S. financial assets that keeps the dollar high. As a result, the U.S. is not competitive on exports on global markets, and so we have a trade deficit. Why can't we just weaken the U.S. dollar? Would you say that the U.S. dollar is objectively overvalued, whether you look at it on a purchasing power parity basis or other basis? I mean, isn't it the case you go to many countries, and as a U.S. tourist, like, you get absurdly good deals just because the U.S. dollar is so overvalued? And then in financial markets, you could make the case it's overvalued as well. But shouldn't the U.S. dollar be, I don't know, 30 to 50% weaker? And is the U.S. dollar as a reserve asset, or just the hoarding of dollar assets globally, is that a cause for this U.S. dollar overvaluation that is causing the problems we're talking about?
So I wouldn't use the term overvalued myself, but I can certainly understand why people would be. The dollar is strong historically and what have you. But once again, if we have a regime of relatively open trade and open capital flows, the market's setting that price. And there's a great demand internationally for U.S. assets. And that's what I think the dollar reflects. Should we want a lower dollar? Well, the question is, how do we bring that about? So here's where there are various policy options. More expansionary policy might reduce the nominal value of the dollar, but may not affect its real value. In other words, the dollar will fall with respect to higher rates of inflation, but it doesn't change the relative nature of the dollar. In other words, there's a difference between the real exchange rate and the nominal exchange rate. So it's not clear that monetary policy, it's not a policy tool of the dollar per se. So monetary policy can indirectly affect it, but may not affect the fundamentals. They're taxing capital inflows but think about what this requires. It requires making U.S. assets less attractive to foreign investors. So here's where you get into costs and benefits once again. What's the benefit of having this trade deficit with this capital inflow? Lower interest rates for U.S. firms, lower interest rates for the federal government, lower interest rates for U.S. households, higher stock valuations for U.S. firms, greater amount of venture capital that's available for entrepreneurs to invest. So those are some things we're saying we want less of. In particular, when you think about the fiscal position of the U.S., every tick up in interest rates has big implications for the future trajectory of debt and debt service. So that's really saying, okay, if we're not going to borrow as much, fine, but that means we're going to have to either spend less or tax ourselves more to close that fiscal gap if we can't borrow as much. So what I'm just suggesting to you is that, gosh, it may seem great that we have a lower value of dollar and less capital inflow because it helps out U.S. manufacturing, but there's going to be, once again, ramifications for other sectors of the economy that we may not like. As Milton Friedman famously said, there's no such thing as a free lunch. We're not going to be able to get to this better world without giving up something. And we may rue the day when we no longer have the capital inflows that we've enjoyed over the past few decades. So that's one aspect of it. Let me go back to another point that I just thought about. Because I think you mentioned implicitly currency manipulation, which is a very important aspect. That is it foreign governments, foreign central banks that are accumulating dollars, buying up dollars, keeping the dollar stronger than it otherwise would be, to accumulate dollar foreign exchange reserves. That was very much the case with respect to China in the 2000s, where their foreign exchange reserves went from just a couple $100 billion to $4 trillion I think their foreign exchange reserves, their dollar holdings reached 4 trillion around 2010, 2012, or something like that. That was a clear case of currency manipulation in the sense that it was the China intervening in foreign exchange markets to buy up dollars and accumulate them. But if you look at more recent data, and here Joe Gagnon and others at the Peterson Institute for International Economics have sort of worked on this, over the past decade or so, it has not been foreign central banks that are accumulating dollars. It's the foreign private sector that has been. And so once again, this goes back to the fact that the private sector and foreign investors in the rest of the world, not government actors, really want to buy dollar-denominated assets, either for the safe haven aspect of it or for the higher rate of return in terms of stock equities and what have you. And so we have to think about whether we don't want that, whether we want to discourage that in some way. So the reason I don't use the term overvaluation, it's a little bit pejorative. Yes, if we didn't have these capital inflows, the dollar would be lower, but we do have open capital markets, and those are the dollars reflecting those flows. So from a trade perspective, or a merchandise trade and service goods and services say, it is overvalued because we don't have current account balance. But once again, we have to think about the capital flow side as well.
And what about if the U.S. Treasury, which is in charge of dollar policy, as Chair Powell always reminds us, weakened the U.S. dollar by calling the Federal Reserve and just instructing them to just sell dollars and buy foreign currencies?
Oh, yeah. So that could certainly happen. We could intervene in the foreign exchange market and try to push down the value of the dollar. And there was the Plaza Agreement in 1985, where Treasury Secretary James Baker, in cooperation with the Federal Reserve Chair Paul Volcker, did exactly that, although the dollar had been depreciating in advance of that meeting as well. The big question for monetary policymakers is, if you start selling dollars, will that stoke inflation, or can you sterilize those dollars and pull them out in some other way, have offsetting monetary policy operations that will offset the monetary impact of those sales of the dollars to keep the inflation rate low? Or would it just lead to higher inflation? In selling dollars, you're pumping more dollars out there for people to have access to. So you would think there would be some inflationary effect. In fact, when the dollar depreciates, of course, it would increase U.S. inflation a little bit because import prices would rise as a result of that weaker dollar. But once again, no such thing as a free lunch. You can push down the value of the dollar, but if you're getting higher inflation too, that's going to be costly on some other dimensions.
Professor, there's an equation that basically says that the current account and the financial account, capital account, have to balance. So the US has a current account deficit. We have a trade deficit that's massive, and then a services surplus that is less big. And then you add those together with some other adjustments, and you have a US current account deficit. But then the capital account, by definition, is just the opposite of that. I have a question, which is, what if a country has a current account deficit and the foreign investors are selling those assets at the same time on the financial market? So in reality, through the trade channel of goods and services and through the financial channel, they're selling those currencies. Does the equation still suggest that the capital account still has to be in surplus? And if so, how?
Yes. So what would happen is there'd be another line in there, which is the government reserves. So the government has to be financing this somehow. If you're running a trade deficit and there's capital flight away from your country, that means everyone's sort of selling your own currency, and to get dollars or what have you. How is that possible? It's only possible if the government's selling its dollar foreign exchange reserve. So that would be, its currency would be plummeting then. The government would be hemorrhaging foreign exchange reserves, but that would be needed to make the balance payments add up. But yes, it's got to add up at the end of the day.
Okay, and so the central bank would the central bank would be a buyer of those currencies. So the central bank would be the capital surplus.
Exactly. Yeah.
Okay, thank you for explaining that. That was something that I have been trying to understand for a long time now. So thank you. So is the U.S. in the role of Great Britain, perhaps, that in the 1930s? And I'll explain what I mean, which is, in your book, Trade Policy Disaster, Britain was like, okay, we can devalue or we can impose exchange controls, but there was a lot of strong resistance because London was the financial center of the world at the time. Are we in the same situation where we really should devalue the dollar, but that would cause some trouble for the global financial market, so we don't?
Well, there's a big difference between Britain at that time and the U.S. today. Today we have a floating market set exchange rate. Back then, the value of the pound was set by the central bank, the Bank of England, in terms of U.S. dollar, but more importantly in terms of gold content. So there was a policy lever that the Bank of England had to devalue the British pound. Today, we don't really have that policy lever of devaluing the dollar, as you sort of just suggested. The Treasury could instruct the Federal Reserve to intervene in foreign exchange markets to push down the value of the dollar, but it's not sort of changing the price of the dollar per se in a step fashion because we have it fixed.
So, what do you think are the negative consequences of these tariffs besides lower growth?
I'd say, we can talk about the economic aspects of it quite a bit in terms of, well, go to the webpage of the Yale Budget Lab or the Congressional Budget Office or some other private forecasters. They're all going to talk about price effects, GDP effects, possible employment effects, which we don't really know yet. Clearly, it's creating uncertainty, which is harming business investment. Clearly, there's a lot of uncertainty about the future path of those tariffs. But I guess, which it would be sort of odd for an economist to point out, I worry about our foreign relations because we have not really distinguished our friends from our foes. In fact, President Trump sometimes says our foes treat us worse than our friends treat us worse than our foes.
Yes.
And I don't think that's the case. We're hitting countries that we've had harmonious trade relations for some time. We're hitting countries that we've had free trade agreements with, Canada and Mexico, Peru, Australia, Korea, a bunch of other countries as well, with high tariffs. And so I think that the deterioration in our foreign relations and our relationship with those countries that have been allies for so long, I think is a disturbing aspect of this. And this gives rise to unwillingness, I think, to cooperate with the US in the future. And certainly when you look to Canada, very much an anti-American attitude, saying that, we're a close friend that has supported you in the Iraq War and all sorts of other places. And we have joint security concerns across the Arctic. And yet you're treating us like this and willing to pose pretty high tariffs on us. And so I worry that in a dangerous world, we need friends. And when we're using the tariff instrument in such a blunt and undiscriminatory way, we're hurting a lot of friends that would have supported us in the past and might not be quite so willing in the future should we need their help in some way.
So there's the geopolitical concern of treating your allies not well and having preferences. But what about the specific retaliation point? Do you buy the argument from the Trump administration, I guess Scott Bessent as well as Steve Moran, that the rest of the world is the U.S. is the global consumer, and so we have the cards because we are the deficit country. Other countries, it will hurt other countries more if we have tariffs, so they're going to do a trade deal with us. And basically, I guess that because of basically foreign supply is going to be inelastic to tariff rates, much less so than the U.S. consumer.
2 points to be made here. First of all, I have been a bit surprised that there has been not as much retaliation as I would have thought. Certainly, the European Union and Canada had been talking about retaliation after April and had drawn up retaliation lists, but ultimately they decided not to execute on that. Only China and now maybe India will be retaliating in a big way against the United States. So the administration has been sort of right in the sense that there has been less foreign retaliation than we might have anticipated. I don't think they're right in terms of saying we're winners from this or we hold all the cards, because what these tariffs are doing is they're taxing American consumers of these products. So it's not a tax that we're not taxing other countries, we're taxing ourselves. And
companies, we're taxing consumers or companies.
Or companies, yes. It's going to come out of their profits or what have you. And Ford and GM and Apple and others have already announced what sort of a bite they're taking as a result of these tariffs. So I think we just have to recognize the fact that it's a tax on ourselves as much as it is on other countries, and it's not going to help U.S. consumers. So it's certainly not going to help other countries. So I see more losers rather than winners as a result of all this.
Let's talk about tariff incidents. Who pays tariffs? If there's a tariff on cars made in Germany that I'm going to import, is it Volkswagen who pays the tariff? Is it the German government who pays the tariff, or is it the U.S. consumer who buys that Volkswagen who pays the tariff?
Great question. And there's a difference between the formal who pays the tariff literally and the incidence who ultimately pays the tariff. So the importer pays the tariff. If they want to get their goods through U.S. customs at U.S. ports at Long Beach or in Boston or in New York or Newark or what have you, they have to write a check to the federal government to allow those goods to enter into the U.S. Now, just because they've written the check doesn't mean they're paying, because they're probably going to have to mark up the price of their goods to the domestic consumers to absorb that tax, because the tax is going to be large enough so that they can't absorb that, and their profit margins are not so large that they can continue to import and pay those. And so there have been a lot of studies done by economists from the tariffs imposed during the first Trump term, which indicated almost complete pass through of the tariffs to the final consumer, either the business consumer or to an American household. So all those tariffs seem to have been passed forward to the ultimate consumer, which once again is suggesting we're paying, not the foreign exporter. I've heard press reports of Goldman Sachs studies saying that 4/5 of the current Trump tariffs, that is in April, May, and June, and now into July, are being paid by domestic consumers, and 1/5 being paid by the foreign exporters in terms of them taking lower prices. I've seen that analysis, but once again, that indicates that most of the tariffs are being passed through to consumers here in the U.S.
Okay, so literally 100% of tariffs are paid by the importer who imports it from country XYZ into the US. That company importer could be a US company, it could be a foreign company. And then the incidence question is, does the tariff cost come out of that company's profits, or does it pass along those costs to consumers? While you were speaking, Professor, a third option did occur to me, which is, what if this Volkswagen is losing money because it's paying all these tariff rates? Yes, it could pass it on to the US consumer, but it also could, basically whine and cry to its government, and the government could subsidy it. So technically, there could be some tariff incidence on the German company and on other countries, right?
Yeah,
Technically.
I haven't heard many instances of that, or any incidents, but it could happen.
Okay. Okay.
Then the complaint would be foreign governments subsidizing their exporters.
Yeah, we need to
So
tariff more.
exactly.
It's interesting you said the Goldman Sachs thing. It's tough to see. I know that for the second quarter, literally import prices actually went down, but again, it doesn't mean that there wasn't a tariff impact of prices. So, do you think that tariff incidence is going to be high? You said that a lot of academic literature said that it was high from the Trump's first term tariffs. You expect them to be similarly high?
I would expect they'd be similarly high. And once again, it's early days. We're recording this in early August 2025. The second round of tariffs have just been announced. So we'll need a couple months, a few months, maybe 6 months to sort of see what the data show. But I would expect that it would show still a lot of pass through to consumers.
All right. And to revisit an earlier point, you said that tariffs don't promote domestic industry because tariffs on inputs is going to be a cost. So the Boeing is going to suffer if there's tariffs on steel, even though the steel tariffs help the steel companies. What does economic theory, what do the equations, what do you say about an economic model where a country whose name, let's say, happens to be the United States, imposes tariffs on the rest of the world, and the retaliation from other countries is literally zero? This is just an economic model. And so US imports go down, US exports are flat. So net exports goes up. They either turn positive or are less negative number. What does your economic analysis say of that scenario? Even if it is a fairy tale scenario, what do you say about that scenario?
Well, certainly that's the one that I think the Trump administration is hoping for, and that the tariff will reduce the trade deficit because imports will go down, but exports won't go down. What I've suggested to you is that theory and previous experiences suggested exports will go down through various mechanisms. We already sort of see that a little bit, even though there hasn't been retaliation. A lot of foreign airlines are saying we're going to buy Airbus instead of Boeing, and that gets back to that sort of anti-American attitude that you can't really quantify it. It's not a formal retaliation. The government's not ordering it. But if the U.S. is viewed as an unreliable supplier or an unfriendly force, you want to go with different suppliers. So, I'd say we just have to wait and see what the data show, whether imports go down with no impact on exports. So there's just a one-for-one reduction in the trade deficit. But once again, that can't happen without the capital flows also adjusting. So we have to think about, how our capital flow is going to shrink to the U.S. or expand to the U.S. Here's one of the contradictions in the Trump package is we're imposing all these tariffs, hoping that the trade deficit goes down, but also demanding in these deals that foreign investment pick up to the U.S. Usually he wants direct investments, not portfolio investments. So in other words, not sort of buying treasury bills or buying a stock, but actually physically setting up plants here. We don't know whether this is enforceable or whether it's really going to happen, but that's calling for more capital inflowing into the U.S., or at least changing the shape of that. And we'll have to see how that plays out too. But let me just say, if we actually do get more additional foreign investment in the U.S., that's really great for our capital stock. But it's also not going. That means we're not going to close the trade deficit because once again the trade balance is just the gap between is filled by those foreign capital inflows, and if we have more capital inflows, wider trade deficit.
So the capital account is foreign direct investment as well as portfolio account.
Exactly.
So it's buying treasury bills or Apple investing $100 billion in the US to build factories. That is going to be the same effect. Although buying $100 billion of treasury bills would appear immediately, whereas the US, if Apple is going to truly spend $100 billion, that's going to be a long duration platform.
Right.
So you think exports are going to go down? And let's in that environment where let's say exports didn't go down. Okay, imports went down, but exports didn't go down. Again, it's a fairy tale world, but just granted to me. Is consumption going to go down as well? And would consumption go down by the correlative amount that imports go down by as well? Because if imports go down, that means net exports go up, which means GDP goes up. But do you get that offsetting effect by consumption going down?
You could. I'd have to think it through a bit, but there may be that effect. I mean, the way to think about it, I guess, would be this way: countries that have current account deficits are consuming more than they're producing. Countries with current account surpluses are producing more than they're consuming. So it's the balance between the two. So if we want to close the trade deficit, that means either we produce more or we consume less to close that gap between the two. So it could be under that idealized scenario you're suggesting that the foreign capital comes in, we expand production, which enables us to not reduce consumption as much and close that gap a bit.
Okay, so remember when I asked you that question about what happens if the capital account, if the trade deficit, current account deficit is negative, but also foreigners are selling it, that the way the equation says it has a positive capital account is the central bank defending the currency, I guess, and selling foreign reserves. Could we have the reverse of that if we have tariffs and the current account deficit narrows? You're saying that foreigners will have to sell less as well. Could the central bank get involved and kind of fix that equation?
So the scenario
Yeah.
you said before was you have a current account deficit and you have a capital account deficit. How does it all add up? Or you're saying, could that flip? Could you have a current account surplus and a capital account surplus? And that would be yes. Obviously, what would be happening is the government would be accumulating foreign assets, both on the financial side and on the trade side. In some sense, maybe that was what China was doing in the early 2000s when its foreign exchange reserves were going up so dramatically.
I see. And earlier when you said that all the investments into the US are going to drive the capital account more positive, which means drives the current account more negative. I just it seems like the way that equation is you can't really escape it, and that the US is kind of destined to have a bigger capital, a bigger current account deficit.
Well, to the extent we're demanding foreign investment come in more, yes. But that doesn't mean that there's nothing we can do about it. As I mentioned, a fiscal adjustment on the US, we have a huge fiscal deficit, which is a huge drag on US savings, which means we do have to have higher interest rates than they otherwise would be, which it does attract a lot of foreign investment. So if we stop borrowing as a society more through the federal government, if the government were to close its fiscal deficit, which I think is about 6% of GDP, and bring that down to 3 or 2 or 1% of GDP, or lo and behold, budget balance, that would work in some way to reduce the net pull of capital from the rest of the world and possibly improve the current account position from a deficit to a smaller deficit or balance. So that'd be one mechanism that I think would be worthwhile, not for good reasons of good fiscal policy as well as on the external account side.
That makes sense. So we talked a lot about Smoot-Hawley, but going back even further, your book Clashing Over Commerce. What is the history of tariffs in the U.S.? Did they work? Because you have a correlation of tariffs were high at a time when U.S. manufacturing grew rapidly and ultimately ended up being dominant. So President Trump, whose favorite president is McKinley, he calls him a tariff man, and he says, "I'm also a tariff man." He makes that correlation of tariffs were part of the reason why we had such a strong industry, because it allowed us to build and to export. You've thoroughly reviewed the history. You're one of the most top experts in the world on this topic. Is that completely false? Completely true? How do you judge that statement, that analysis?
Well, it goes back to the old saw: correlation does not necessarily mean causation. So everyone looks to the late 19th century period, say 1870 to 1913, say, gosh, the US had really high tariffs and we industrialized a lot and grew rapidly. Therefore, one caused the other because tariff was protecting domestic manufacturers. And so they got that expansion. Two things you have to sort of look with respect to this. First of all, no one really looks at the period 1840 to 1860. That was a period in which we were industrializing just as rapidly, albeit from a smaller base, but tariffs were going down, not up. So there was a lot of expansion then, too, expansion of the railroads and what have you, but arguably not tariff driven. Then when you go back to the after the Civil War period, the 1870 to 1913 period, the problem here is with determining what was the impact of the tariff, because there were a lot of other things going on. We're expanding to a continental market. We were using the railroad to move westward in a big way. We had a lot of immigration. So, and immigrants were really, providing the labor for America's factories at this time. So there's a link between industrialization and immigration. We were also expanding the national banking system. So the national savings rate went up and investment rates went up as well. We had a lot of mineral resources and resources from all around the country. Iron ore in Mesabi, Minnesota, copper out in Arizona. So we were exploiting those resources. When you look at what sectors were growing rapidly in terms of productivity, it wasn't manufacturing that was really outstripping other sectors. It was the service sector in particular. So that's because of railroads, financial services, and other things like that. So in other words, that period of time from 1870 to 1913 was an incredibly rich period in U.S. history. A lot was going on. And tariffs were one element of it. But the tariffs were sort of set at a high level and just sort of maintained there. They weren't varied across industry so much. They weren't going up and down in a way we could identify, oh, gee, if we cut the tariff, bad things happened. So it becomes very difficult to determine. Well, some people have looked at it and said, it actually didn't help out productivity growth very much. Chris Meisner at UC Davis has a recent paper on this, and others have looked at it too. So it's a complicated picture. A lot of other things going on that you have to sort of hold constant to identify the impact of the tariffs.
Thank you, Professor. And it was from your work earlier this year when I first discovered your work. I learned that President Trump talks about this McKinley tariff as raising tariffs so much, but it was kind of like the Smoot-Hawley tariffs. Tariffs were already very high, as you said, basically during the Civil War and right after Civil War. And then they budged a little bit up and down and up and down. But the McKinley tariff of 1890 was, a somewhat marginal change. And I want to ask you, is it President Trump's claim that is it technically true what he said? Is President Trump's claim, the following claim, is that technically true that the U.S. had so much money from tariffs, i.e., the trade surplus was so big that it didn't know what to do, and it had a commission about what to do with all this money from the trade surplus? Isn't that technically true?
No, we didn't have a trade surplus. We had a budget surplus.
Okay. Right.
So, and this is sort of the legacy of the Civil War. So the Civil War was obviously very expensive. We accumulated a huge amount of debt. And so we spent the 1870s, 80s with a big budget surplus to draw down the debt, to pay off the debt. And so this is a fiscal policy issue. And there was this issue by mid 1880s. In fact, I think there was a Tariff Commission of 1888, which was saying, actually, we could pay off the debt, exhaust the debt very soon. What should we do about this? Should we, adjust tariffs up or down or increase spending? So something known as the Great Tariff Debate of 1888, which is a nice rhyme and alliteration to it. And what it's referring to is the debate was, we've got this huge fiscal surplus. We can't continue it forever. We have to get rid of the surplus. It's become a problem. How do we get rid of the budget surplus? Which is actually, that's an easy problem to have. When you're trying to solve a budget deficit, that's difficult. But if you, in your terms of your household, if you're earning way more than you're spending, that's not really a problem. So the problem, you can solve it one of two ways. You can spend more or bring in less tax revenue. And here's where the debate was over the tariff. The tariff was one component of tax revenue raising, obviously, at the time. Democrats said, well, we have the surplus. The obvious thing is a tax cut. Let's cut tariffs. Republicans said, no, that's crazy, because if you cut tariffs, you're going to encourage imports and you get more revenue. So what you need is to raise tariffs to squeeze out imports to reduce revenue. You might recognize that's the classic Laffer curve debate. If you want to raise revenue or reduce revenue, do you increase tariffs or decrease tariffs or taxes? Because it's not obvious which way you go. And so it's a debate about which side of the Laffer curve you're on. That's what was going on at the time.
And so the Republicans wanted to raise tariffs, McKinley wanted to raise tariffs so that tariff revenue would go down.
Exactly. Yes. Yep.
And did that work?
So I actually did a whole paper on this in the Journal of Economic History. And if you look after the impact, after the McKinley tariff, revenue did go down, but they did so for a very interesting reason. One of the biggest items in US imports at the time was raw sugar, and it was pretty heavily taxed. And what they did is they put raw sugar on the duty-free list. So that's not raising the tariff, that's eliminating the tariff. And of course, the revenue went to zero. So total revenue did go down, and they declared mission accomplished. But they did it not by raising the tariff, but by reducing it on that one big item.
Did actual tariff rates, I guess, weighted average tariff rates go down, even though official tariff rate went up, but you're excluding sugar, which went to zero? So did the effective tariff rate go down?
The effective tariff still went up. And
Okay.
what you can do is you can look at that residual category. The tariff rate went up, and revenues on those tariff goods did go up. So that suggested if we just imposed higher tariffs on everything, we would raise more revenue, not less.
I read that piece. It was very good. I can link in the description. And I really like the chart, I guess it was at the end, of what happened to sugar prices. And sugar prices in the US went up, sugar prices outside of the US went down. So you did have that bifurcation of sugar prices. Is that kind of the standard, what standard tariff theory says is what happens, is that there's inflationary impact of things in the US, but somewhat deflationary outside the US?
Yeah, so that's actually a separate paper looking at the
Okay.
incidence of the tariff, because it gets back to our earlier discussion about who pays the tariff, and it's sort of it's a difficult one for economists to answer, unfortunately. So this was a period where I sort of had access to some unique data, the price of sugar as it came into the U.S. and the price of that same sugar after the tariff, right on in the U.S. right at the same point in New York City. And so we can see what happens when tariff rates go up and down on sugar, what's happening to these two prices. And I found, first of all, let me just say that most economists, I think, would think for the US, because we're a pretty large country, when we impose a tariff, the tariff burden would be shared partly on US consumers and partly borne by foreign exporters. And when we talked about tariff incidence before, we said actually that didn't sort of show that with the first term Trump tariffs. But in the case of sugar, there was that split a little bit when we increased the tariff. But interestingly, when we reduced the tariff on sugar in the late 19th century, that was 100% passed through to consumers. So there's an asymmetry in the impact of the tariff, whether it's going up or down. And I try imperfectly to explain that asymmetry in the paper.
What did you make of the recent European Union deal where I think, according to Financial Times, my reading of it, that the US is imposing a 15% tariff on the European Union, and the European Union's retaliation is zero. And also the EU is going to buy a very large amount of energy products, which they may have bought anyway, so that's not super relevant. But it appears to be a win for the President Trump administration. In what did you make of it? And also, does this scenario, is that any way resemble my fairy tale scenario of zero retaliation? Imports go down, exports don't go down?
Well, we don't know that there's not going to be that export effect, because it's not just retaliation that could lead to it. But it certainly is sort of a quote unquote win from the Trump administration standpoint that they didn't get retaliation. They basically got what they wanted. I think the Europeans were just hoping for some stability and sort of were in a not a good negotiating position. They also wanted to keep the administration on board on Ukraine, maybe. So there are a whole bunch of different factors. But I know there's a big debate in Europe about whether it was wise not to choose to retaliate or not. I was a little bit surprised they didn't show more resolve in standing up to the administration, but they did what they felt they had to do. And maybe they're just hoping this is a 3-year agreement that doesn't last any longer than that, and then things will change. I don't know.
Professor, I've heard people say, they make the case that actually, as much as some Republicans and almost all Democrats oppose these tariffs, that once people who are not Trump get to be president or in power, that these tariffs, they're actually not going to reduce these tariffs because it's just a convenient way to raise revenue. What does your historical analysis say about that claim, that once tariffs are in, they're kind of hard for the government to get rid of because it's just, they make so much money? And if you cut those tariffs, you either have to borrow more or cut spending or do something like that.
Yeah, it's not just that effect, but I do agree that there's a status quo bias. So whatever the policy is, it's very hard to change it. So the way I've sort of put it is tariffs can go up quickly. President Trump has done that, but they'll come down slowly. We saw that, we talked about the Great Depression and the protectionism of the 1930s. There's tariffs and other trade barriers went up quite a bit, but took decades after World War II to bring them down, 1950s, 60s, into the 70s even, to bring those tariff levels down. So it'll be a slow process, and I think there will be a number of factors resisting any big cuts in the tariffs. So first of all, revenue, that's an important one when the U.S. has a fiscal deficit, but also you get vested interests. So there's a lot of complaining about the tariffs now, but what we'll find is that the tariffs will help out certain domestic producers that will start producing in those high tariff sectors. And then if another administration comes along and says, well, we're getting rid of the tariff, they're going to start complaining, and they'll write to their members of Congress, and there'll be resistance. Also, because the U.S. is sort of unilaterally putting these tariffs up, usually it would be very difficult for a future administration to say we're unilaterally going to bring them down, because the demand would be, well, you have to get something. You have to, if you're going to give, quote unquote, give other countries something by reducing the tariff, you have to get something in exchange. So there'll have to be some new deals struck. It won't be the U.S. just undoing what the Trump administration did. There'll have to be a new round of negotiations a future administration can say, well, we got rid of the tariffs. That's tariff tax relief for U.S. consumers, but we also got something from other countries for doing so.
What do you make of the claim that other countries, quote unquote, cheat on trade? Obviously, you would never use such a emotionally laden word, but of the actual claim underneath, either with tariffs or with quote unquote non-tariff barriers?
Non-tariff barriers are much more of an issue than tariffs. I mean, first of all, we have free trade agreements with a lot of other countries, Canada, Mexico, of course, and a bunch of other countries as well. Even European Union tariffs are pretty low on average against the US, so there's not some big disparity there. But regulatory policy, and in the case of China, those domestic subsidies, those are things that trade agreements don't reach quite as well. And those are areas that would have been the place where future negotiations would have taken place. But we've shifted all the action back to tariffs at the moment.
What would you say, the argument from Robert Lighthizer, he used to be in Trump's first administration, the U.S. trade representative. His deputy, Jamieson Greer, is now the U.S. trade representative. He provides a lot of the intellectual heft on the conservative movement, the MAGA movement, for tariffs. I'm sure you could provide 20 arguments to rebut his argument, but what do you think is the most potent one that you really want to just scream from the rooftops?
It wouldn't be just one; it would be a couple. One is, and I mentioned this to you before, we've lost manufacturing jobs largely because of technological change, less so because of foreign unfair trade practices. So I guess another point would be trade deficits aren't necessarily a bad thing and don't indicate unfair trade. We talked about the role of capital flows in that. But what I would say is that even if you grant some of his views on the shape of the U.S. economy or what have you, or view the trade deficit as a problem, view the lack of manufacturing jobs as a problem, the question then turns to, well, what's the right policy approach to address that problem? And rarely is it going to be tariffs, in my view. If you want to increase manufacturing employment, there's some very specific domestic things we could do to increase employment in manufacturing. Think the trade deficit's a problem. We talked about the fiscal adjustment and making U.S. assets less attractive in some way as a possible remedy. So tariffs just either are a costly way and inefficient way of achieving the very objectives that we might share across the political aisle.
And so a conclusion I'm drawing for this conversation, Professor, is that the U.S. dollar system that was designed, partially after World War II, partially after 1971, it was made so that the rest of the world will invest in the United States and have the dollar as a reserve asset. That system may be working too well. Would you say that's a fair conclusion to draw?
I don't know, working too well, what that means. I mean,
the demand for the U.S. dollar is too high so that the U.S. dollar is overvalued, so that exports are not competitive. That's what I mean. Sorry.
Right. I mean, so the Bretton Woods system initially had a lot of controls on the international flow of capital. So that's why we had basically a current account balance in the 1950s, 60s, into the early 1970s. And it's when we liberalized capital flows that big current account imbalances appeared. If we don't like those current account imbalances, maybe we should think about doing something to regulate capital flows again. That would be sort of the policy conclusion, but that would also mean higher U.S. interest rates, less foreign capital inflows, and we'd have to balance our own books domestically to a degree we haven't in the recent past.
That makes sense. Professor, you can be found on Twitter at D_A_Irwin. I have 3 of your books: Trade Policy Disaster, Clashing Over Commerce, and then also Peddling Protectionism. what we also got against the tide and free trade under fire. I finally want to know is you talked about the U.S. putting taxes on foreign imports of capital. I think that was in the talks among the Trump administration with the Big Beautiful Bill. I do not think that made that into the Big Beautiful Bill. So if you're saying that's a key thing, the Trump administration chose not to do that, maybe for political reasons. Professor, my final question for you is, tariffs are on goods and services. The U.S. has a negative trade account, a very positive services account. Are there any tariffs on services? And has that ever been a thing or no?
No. In fact, that's a very important point to make, is that the Trump administration is focused mainly on trading goods. And that's where the taxes are. Now, you can't really tax services in terms of exports and imports because they're digitally provided, they're not really tangible things that are coming into ports and what have you. But of course, you can have like the digital services tax and other things that are sort of behind the border that are controversial, but you need international negotiations to resolve them because they're not on trade per se. So services tends not to be directly trade taxed the way merchandise can be.
Professor, thank you for coming on Monetary Matters. A reminder, people, to subscribe to the Monetary Matters YouTube channel and to leave a rating and review for Monetary Matters on Apple Podcasts, Spotify, and wherever else you get your podcasts. Thanks for tuning in. Looking into SMH or SMHX? Head to vaneck.com/SMHjack and vaneck.com/SMHXjack to learn more. Until next time.
Thank you. Just close the door.